Mike Muller, the other big story, obviously, again, part of these multiple narratives last week was the idea that the US and others, whether they should sanction Russian oil, and that Russian oil and gas were still not part of the sanctions, and yet were being substantially disrupted because of the mechanics of the sanctions and people's uncertainty about the legality of things. But yet, with oil trading, I mean, Brent closed at 118, but yet the discount to Urals was so massive that Shell couldn't help itself. Business is business, and if it's legal, I'm buying. Your thoughts of where the market dynamics go as long as Russian oil and gas lifting it is legal?
Yes, I mean, I wouldn't quite put it that way, saying it was irresistible opportunity or anything like that. I mean, it is not illegal to purchase Russian oil yet. However, the means to do so are being tightened, where not by government imposition, then certainly by voluntary moral imposition of restraint, be that ship owners, be that insurance companies, be that the people that help maritime things move. And in this case, of course, the economic incentive compared to historical norms for Urals, which would have traded for the last 8 or 10 years at between -10 and +$1 per barrel versus Dated Brent, is indeed phenomenally large. I mean, on a standard sized cargo from the Baltic to Rotterdam, where this cargo is probably going, you're talking about an incentive of $15 to $20 million, just to be conservative. However, I'm pretty much convinced that that's not what Shell's after, and Shell actually came in afterwards saying that the proceeds from this uplift in revenue would go to humanitarian aid, which I think is a smart way of putting a postscript to it. But yes, their line was very simply, we had to consult with politicians, presumably in Germany or Netherlands, where Urals is such a large part of the supply chain that stockouts will be a consequence. And therefore, I imagine that Shell would have put a question to government: do you prefer that we run out of oil in a part of the Rhineland, or are you okay with us making this purchase? I'd be very surprised.
Are we in that?
Yeah.
Are we? Is that a credible argument? Is that a credible? I mean, in terms of, is the market that tight that if you don't lift this Russian Urals, I mean, some reporting is saying it's already disrupted by about 4 million barrels a day. If you don't lift it, as your example in the Rhineland could be, or whatever geography, could actually be without oil or without that requisite energy.
Absolutely. And I mean, I don't need to be accused of sticking up for my former company here, but the market was already extremely tight on oil. I mean, last time you had me on this panel was early February, and we had no idea nothing was going to go on in Ukraine. Yes. And I was telling people, watch out, we're just one headline away from this market spiking because of low inventories. And we had backwardation back then, which was disincentivizing storage, and we had already had SPR releases. So what a headline, I guess. I mean, it is without a doubt a fact that in places like Germany, where some refineries run 100% Urals and others have it as the largest grade in their diet, it is awfully hard to come by other crude when you have a delay or a disruption in the supply of any other crude stream. And just look at what's happening in Libya, just as one of many examples of disruptions. So I mean, a lot of headlines that would normally be front page have been drowned in the back pages as we all consumed by this Ukraine tragedy. But yes, I do believe that it would have resulted in stockouts, and there are some headlines out there saying it would probably have been a stockout. I'm convinced that it would have definitely been a stockout, and then it's a question of, do you want to start inconveniencing Western consumers? And of course, this is the point: inconveniencing in the light of the tragedy we're seeing on television in the Ukraine. You are beginning to see headlines about the fact that yes, maybe we should start inconveniencing ourselves. But a couple of observations, because in the global picture, you still have some places that are buying Russian oil. And you asked about the bigger picture. China came out with a statement last week saying it's business as usual. They will continue to not sanction and therefore continue to import Russian oil. And of course, China consumes most of the ESPO, the Pacific Russian crude that comes out just on their doorstep. The consensus view now is that they might have to be the backstop home for a lot of the Baltic Urals and even Black Sea Urals, to the extent that it's loading. That will have to find its way east if the West rejects its wholesale. And in that scheme of things, yes, you just at $118 Brent price, is 28 the right number? I think you will probably find that other companies engage with governments and get the okay to buy as well. But that's just oil. Let's look at other commodities. Oil has actually not yet made its all-time highs unless you express oil in euro terms, in which case it has. But remind ourselves, the high in 2008 was 147, so another $20 to go. But if you look at other energy markets that are of more importance to Europe, especially as it's still, the end of winter, coal, natural gas, these are all-time high prices. Natural gas went and triple peaked at a price in excess of 200 euros per megawatt hour. And API2 coal is trading at a $430, $440 last time I looked. So you could again say that the oil supply chain is a little bit more resilient, has more depth to it, and hasn't yet panicked in the way that those utility markets already have.
And just to pick up on the OPEC point, we had the OSPs over the weekend, Saudi raising prices again. OPEC didn't act last week. The IEA called it disappointing. Others called it head in the sand. How would you analyze it?
Well, because the Saudi OSPs take into account things like the structure in the Dubai market for Asia and the Urals differential in Europe, in very large terms, the Saudis would have had to follow the Urals market, which is at the point they issued their OSPs was a notional price. And of course they didn't, because there's already, certainly from talk in the market, there is a stronger uptake and a stronger nomination for more oil from Saudi Arabia and from OPEC as a whole than they have in mind to put on market as per their last meeting. So they're going to have this challenge every month now. The market's going to be asking them for more than they give or than they're prepared to give. And at some point, surely the temptation is there at 120, 130. At what price will they say, okay, I think our COVID response that we agreed in early April 2020 is history now, and let's get back to focusing on the fundamentals of today's market, rather than somehow managing inventories from COVID, which is very much no longer the theme of the day. And I mean, yes, the OSPs in Asia, they could have been, I mean, in the current market, they could have been higher. Yes, I mean, they're pricing the oil to move. The model suggested that they come in roughly with the $2.50 on average premium increase in Asia. And in Europe, they of course didn't follow Urals because they don't have to, because there were call-ups from refineries in Europe to buy a lot more Saudi than they have in the past in order to move away from Urals crude. But the disruption is across the board. I mean, ship owners now have the opportunity to put money in their pockets, yes, because in the Black Sea they're going into a war zone, and in the Baltic they're dealing with the challenges of not being able to transship in the Danish Straits, and they're dealing with British port workers being instructed not to receive ships that have any Russian nexus, not just Russian flag tankers. And we have some similar headlines coming out of the US just recently. So I'm not sure whether this minus $28.50 price for Urals is going to be the low and it's going to bounce from here, as you suggest, Sean, in case that's what you were saying. I mean, at $120 oil, some people have commented that the market may yet equilibrate at a different level, but it creates a market that is disjointed. And how on earth do price reporting agencies start assessing not just Urals crude, because that's an easy one because it is what it is, but how do they start assessing products that include streams that come out of Russia, or that might be blended with material that comes out of Russia? It makes the messy assessments in Asia, where let's say sanctioned Iranian barrels make their way into the blend, makes it look a small problem. So I don't envy them. It's going to be quite a challenge.
On the back of that has the kind of big disruption of the energy markets now is going to play out, and we'll get to some kind of new status quo where this becomes manageable? Or is this scale of volatility, do you think, going to remain in the oil markets going forward this coming week in particular?
I'm afraid we have plenty of twists and turns yet to come, and more headline-driven trading. And I'm not sure the fundamentals have borne out what I've been saying yet in terms of tightness and pockets of scarcity expressing themselves in yet steeper backwardation potentially. Indeed, we wait and see what actions of various protagonists will continue. I mean, much centered around the withdrawal of the, well, I won't get into geopolitics here in the concluding statements, but I think the withdrawal of the Russians or the new terms that Foreign Minister Lavrov stipulated around the nuclear talks with Iran. There's another headline that's been drowned recently, but very profound, I think, because it did appear midweek as if they were very close to resolution, and both sides were promising on the Twitter sphere that there was an agreement about to happen, and the oil price reacted accordingly and dipped something like $5 per barrel. It doesn't look like that it's terminally off now, but it does seem like the Russians have demanded that if there is to be a deal, that trade ties between Russia and Iran will not be impeded. by the international banking system, etc. So there are going to be many twists and turns. And I'm afraid that whilst I think the world is already pricing, in terms of the backwardation, the fact that there is going to be an inability to take a serious amount of Russian oil in the Western Hemisphere, I don't think we've priced in everything yet. And there are things that we probably have to absorb into our reckoning here. So